The key to having a successful management company is having good systems and processes and reporting. You need to have somebody who wants to spend time on operations. In the beginning, it'll be a lot of work. You have to appreciate the benefit that it's going to bring you, and that is you're going to have tighter control over your assets.
The Apartment Gurus podcast is brought to you by Greenlight Equity Group, an apartment acquisitions and holdings firm co-founded by Carl York and Tate Siemer, host of this show. We offer you the opportunity to be an owner of cash-flowing, wealth-growing apartments without the headaches of being a landlord. These assets are recession-resistant, risk-mitigated, offer significant tax advantages, and are a great alternative to the stock market. Ready to check it out? Go to www.investwithgreenlight.com today to book a personal consultation with Carl or Tate. Again, that's investwithgreenlight.com. We look forward to meeting you. Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of the Apartment Gurus podcast. And we've got a repeat offender on the show. Mr. Ken Gee with KRI Partners is joining us again. Ken, it's been less than a year. You joined us in August of, well, that's not true. It's been a year and a half, let's say, August of 22. So it was the last time you joined us. So, man, so much has changed in the market in that time. And I know you and I were just chatting a little bit about some changes in your world. I know some huge changes in our world at Greenlight as far as, especially as far as buy box and where we're seeing opportunities, what are the opportunities that we're going after right now. I know you've got multiple funds that you're working on. So I think let's just start with kind of high level catch up, like what, a little bit about like, for listeners that didn't hear the first episode, which by the way was August 30th of 22, if you guys want to check that out. But just, a quick high level of you, KRI, and really like, current events in your world, if you will.
Yeah. So very quick background. Grew up in Toledo, Ohio, got my undergrad there, came to Cleveland. I went, became a commercial lender, spent 5 years doing that while I went to school at night to become a CPA at Case Western Reserve. Went to work for Deloitte for 7 years. That's when I got into real estate. Just got tired of figuring out that my family was going to grow up without me if I didn't make a change. So that's why I made the change into real estate. This is back in the mid 90s. So this is a little old, right? Carlton Sheets kind of days, if those that name rings a bell.
And I remember talking to you about the Carlton Sheets, the Carlton Sheets stuff. I remember that well, the infomercials, the late night infomercials, and zero down, but how to buy a property with no money down, no money out of your pocket stuff. Yeah,
that's right. Yeah, no, that's exactly right. Yeah. Unfortunately, he's no longer with us, but oddly enough, he did single family stuff, and I never did single family. I ended up I couldn't figure out how to make single family work, so I went and started off with a 28 unit building so that I could treat it like a business while I was still working at Deloitte and hire people to help me do that. So yeah, that's how I got started. And fast forward, the first three deals and this was the thing that got me hooked really was, we made $500,000 in that first three deals after 3 years. And as soon as you do that, I'd made more money on the side in real estate than I did the whole time I'd been at Deloitte. So I just said, this is like a no brainer. So, this is all I've been doing since. And now, we've, fast forward, we've done 19 deals, turned 14 of them full cycle, raised 42 plus million bucks.
Yeah.
Distributed another almost 27 or 28, something like that.
Nice.
Million. So, we've come a long way.
Yeah.
And, so, that's probably since August of 22, we probably were kind of early in fund two.
Mm-hmm.
Took us actually a year and a half to find that first deal that we closed on a little while ago. A new deal out of lease up. Just a fantastic deal in St. Pete. but it was tough there to get deals. And so I can feel the market loosening up right now. I got 5 or 6 deals that are real contenders in my box right now.
When the Deloitte days, what year was that when you that $500,000 on your first 3 deals?
Yeah,
during
2000.
Deloitte?
So I sold those in 2000.
Yeah. So 24 years now of track record and experience in the multifamily space. You went through the '08 crunch and everything that happened with that. So
yep.
I guess, looking at the last, since you were on the show, the last year and a half, I mean, have you ever seen anything like this in the market as far as I think specifically in relation to difficulty and in finding deals that pencil and that work?
Yeah.
I mean, you've had multiple funds, you've had, essentially dry powder ready to go.
Yes.
And it's just been difficult. It sounds like it's been really hard for you as well to find the deals that pencil through that period of time. I mean, have you ever seen anything like that in the 24 years you've been in it?
Yeah. So, I mean, the financial crisis proved very difficult to buy. It was because the credit market seized up, right? That's really what happened.
Right.
And so it's similar, but not now, right? So I've every time I see real estate struggle, it's just because of the credit markets clamp down and seize up or dry up or whatever, right? It's some disruption in that part because it's such a capital intensive business that you screw that side of the deal up and it's going to be hard. So, but for different reasons now, right? It's happening for different reasons. And so, no, I mean, I don't think, to my knowledge, I don't think we've had a period of time where SOFR went from 5 basis points to 500 or whatever it is now.
Yeah. 500% increase in interest
obscene.
rates. Yeah.
That's obscene. I mean, that's crazy. So no, it's but it's creating massive buying opportunities now.
Let me start with kind of the ugly part of that whole thing. How have your current holdings and your current deals weathered through that period of time?
Yeah, that's a really good question. So first of all, I remember I went through 08, 09. So I know what ugly debt markets look like. Yeah. And so it has forever tainted me. And I'm always really conservative with debt. So we bought with basically fixed rate debt. Yeah. That's the first thing you got to know. We did have one bridge loan that I got out of in 10 months because I had no interest in staying in it. Yeah. And so we were able to catch rates when I think in one deal we locked at 528 or something. Right. That's pretty good to get locked up for 7 years at that. So we're okay. The reason we're okay, even with insurance going up and everything else, because our business plan requires us to have $200 to $300 in upside. And that's legitimate, right? That's not hope and pray that we get it over 5 years. It's we believe it's there today based on our market research. Yeah. And so that new income has allowed us to absorb a lot, right? I mean, we've continued our distributions, insurance rates are higher. That's okay. We're still okay, right? So it's really our disciplined business plan that has served me well for 25 plus years. It really works in any market, right? You don't buy unless you really understand how you're going to get the upside. And then make sure we manage our own stuff. So we make sure we execute on that business plan. So that's why we're, most of our properties that we bought during that time, they're up anywhere from $250 to $400 a unit in terms of rents. Yeah,
that's tremendous. And like you said, that's built into your business plan and now, when you say, so for listeners, when Ken says, 200 to 300 upside, he's talking about rent premium availability or rent increase of availability per unit and Ken, that's when you say that, is that based on like everything exactly as it is now? Or are you factoring any kind of improvements, renovations into that?
Oh, yeah. So we have a business plan. How are we going to get there? It might be improvements. It might not. Like we bought a deal in 2016, Arbors at Garden Grove. My renovation budget was a whopping $50,000, right? Right. We moved rent $625 a unit. I mean, that's just ridiculous. Yeah. So somehow we just got to know how we get there. My goal is that when I close, I want to be able to rent the first unit and make massive progress against what I think I can get, right? Usually I can get all the way to my projected rents, but maybe I'm a little shy. If I can do that, then I know, right? That's true in place loss to lease. And that's really what we try to do. and then we go from there.
Yeah, sure. Okay. Yeah, it makes total sense.
Mm-hmm.
All right, so let's drill down on a couple things. Let's talk about your acquisition in Florida. And first of all, are you market specific, or are you kind of market agnostic? In other words, are you primarily in Florida or exclusively in Florida?
Yeah, most of what we have right now is in Florida, but that doesn't mean we won't move anywhere else. So I like Charlotte. I like a good chunk of the Southeast. What I want is demand supply imbalance. That's what I need. If I can get that, then I can do okay. So that's primarily where we're focused, Southeast.
Yeah.
But we're very heavy in Florida right now.
Yeah. And you already brought up insurance. I mean, that in those markets, even in the Charlotte's, Southeast markets, insurance is a thing. Florida, it's really a thing, right? Like the insurance premium increase in Florida. I mean, there's even, last I heard, there were even a couple of big players that just aren't insuring in Florida at all anymore, if I'm not mistaken.
Yeah. No, that's right. Yeah. So the market, they call it the capacity is limited, because that means there's fewer insurers in the market, is what that really means, because they didn't want the exposure. So the insurance market goes through cycles. I've watched this happen for 25 years. So rates now, it depends on where it is, how close to the coast, and how old the asset is. But, our new deal, we were at like $2,200 a unit. That's a lot. I mean, for a brand new deal, that's crazy money.
Yeah.
So what happens is, when they're making money, when it's that profitable, eventually it pulls the insurers back into the market, because they can really make a lot of money quick. And then the capacity increases, and then we start to trail off. We are already seeing a softening this
Interesting.
year.
Okay, good.
Yeah, it's really good news. I used to underwrite 400 a door. Now I'm at 2,000. I mean, that's how crazy it was.
Yeah.
It's not near 400, but you can just see things softening. It's going to take a minute, but it'll come back down. I'm pretty convinced. It won't go back down to 400, but it's going to come way off to 2,000.
Yeah. So the new acquisition, you bought in lease up or out of lease up, essentially directly from the developer?
Yes, that's right.
Yep. How far into lease up were you, or are you, and when you bought it?
It's fully leased up. We bought it fully. When we went under contract, they were, 2 vacant out of 102. So whatever that is, that's.
But we've done that too, and for us, kind of one of the things that I think we would look a lot more closely at when we, if we were to do another one right out of lease up, is basically the lease up process, right? In other words, who was managing it, and how careful were they with tenant quality choice, if you will, because their primary mandate is just getting the thing leased up so they can sell it, right? So, and they're not worried as much about the ongoing management of those tenants. Is that a thing for you in this one? In other words, how much confidence did you have in that lease up?
Yeah, so we're pretty thorough in our DD, so we got to see all the credit reports and the income verifications and all that. So when we plan first year to have some significant turnover, because when you lease up, what do? They lower their credit standards. Maybe doesn't seem like they've done that here, but they definitely discount. They definitely like to give away 1 or 2 months of free rent. So a lot of people move in for that. Then when it turns, they're not getting the free rent, then they may leave. And that's okay. I mean, that's part of our business plan. We're okay with that, because then we can get our rent increase even easier, right? Without any pain and suffering by anybody.
Yeah. So how did this one check? This was your first acquisition in a bit, right?
Yeah, not my first acquisition, but it took us 1.5 years to nail this deal. Yeah.
Yeah. So how did this one check the boxes that, so many others probably didn't, that you looked at?
Yeah. What's happened when we're not able to get a deal, it's because sellers are not willing to come to the market, right? There's that big gap right now, right?
Yeah.
Interest rates have pushed cap rates up, and sellers just don't want to sell at that cap rate.
Right.
So you have to find sellers that need to sell, and builders usually don't want to operate. And there's nothing wrong with that. They do what they do really well, and we'll do what we do really well, right? And so that's what you really need. And so there's some of that. There's a lot of people selling stuff that's being built, and then there's still a lot of stuff where people just made mistakes with managing variable rate debt. There's a lot of that, or the lack of execution on the business plan. We are seeing some of that, because you know, especially new people in the business, they don't really thoroughly appreciate how hard it is to execute on these business plans and make sure that they
Right.
happen. So
Yeah, especially if they're using third-party management, which
there
we
you go.
are, and you know that's a variable that you've taken out of play by
Mhm.
self-managing, being
Yep.
vertical on your management, which being on the other side of that is can be unfortunately can be a pretty big speed bump and executing the business plan, so to speak, when you have your third party management not necessarily work out, right? And
Mm.
we've we've unfortunately had the experience of needing to fire a few property managers for that
Yep.
reason, just not being able to get to a place where we're on the same page on business plan execution.
Right.
With you being vertical in your management, that takes that whole risk component out, theoretically, right? I mean, there's always management, no matter
Yeah.
who's doing it, whether you or
Yeah.
anybody else. There's always challenges, right? But yeah, your model kind of mitigates that to a large extent.
Yeah, yeah. What happens? Our company grew up originally in Cleveland,
Yeah.
so there are almost no third-party managers in Cleveland. So if you're going to get in this business, you had no choice but to manage your own stuff. It's
Hmm.
always been an owner-operated town. So we did when we left Cleveland, we just took that mentality with us, right? It's just now 26 years in, our senior management teams manage more than 16,000 units. I mean, you learn a
Yeah.
lot. You have
Yeah.
very well documented processes. So
Yeah.
now going out to the third party market to have somebody manage for us, I see. It seems like that would be a step backwards in terms of expertise because
For sure.
it takes a lot. That's 16,000 unit of experience is a lot of experience, and you
Yeah.
learn a lot. And
Yeah.
so, luckily for us, I like it the most because it gives me the ability to go all the way down to the ground to get real information. Nobody's stopping me because
Yeah.
that happens
Yeah.
with
Yeah.
third party. They don't mean to do it, but they're a vendor now. They're not. You're not going to get the same communication that you would get from your property manager if you employed them directly. So
For
it's
sure.
been really, really, really good for us. I'm probably never going to change that. But again, it sounds like you use third parties and you just have to manage the managers.
Yeah.
You just do and just be quick to, what do they say? Slow to hire, quick to fire. Yeah,
Quick
that's
to
it.
fire. Yeah.
Yeah.
Yeah. Hire slowly, fire quickly. Yeah. Yeah. However that goes, for sure.
Yep.
Yeah, and I mean, almost to that point, almost to a T. Like anytime that we saw glimpses of like this isn't going to work out, but we hung on to try to make it work out, we ended up parting ways. And
Yeah.
so, not
After a
firing.
while, you know what that movie looks
Yeah,
like.
yeah,
Yeah.
yeah. Not firing quickly enough can be painful, for sure.
Yeah.
So,
Yeah. No,
um,
absolutely.
yeah,
And
yeah,
it's the same with people, right? I mean, we built a really, really good team. I'm really proud of the team that we have. So, but not everybody works out.
yeah, yeah. Um, Selfishly, I just want to stay on this for
Yeah.
another couple minutes. It's been a while since you guys. I mean, you guys started out vertically, pretty much. It sounds
Mhm.
like in Cleveland.
Yes.
What I mean, if you were consulting me with a little different format, not a podcast format necessarily, but if I came to you and said, Ken, we've got 9 assets that we're currently under management,
Mhm.
in our portfolio. 6 are in Columbus, Ohio. Oh, actually, we just sold one, so 5 are in Columbus, Ohio.
Okay.
So it would make sense for us to look at going vertical at some point soon. Um, and it's a conversation between, we're out of state, right? I'm actually, many listeners know I'm actually in Mexico now, but we, in Utah before. So essentially, we're whether I'm there or here was, we were handling asset management remotely anyway.
Right.
And so, the conversation becomes like, if you can get a really great third party manager in a market like for us, Columbus, that knows the
Yep.
market, has great systems and processes, it's a leverage point for us, right?
Yeah.
To use them. On the other hand, you just went through all the advantages of being vertical, and those are very evident to us too, and quite appealing in a lot of ways. So I guess, kind of like, if I were to come to you and say, like, Ken, what do you see that we would have to take on to make that happen, and what would we have to kind of put in place? What would we need to look out for? that sort of thing. Could you kind of walk us through like
Yeah.
a high level of that on that?
Yeah, absolutely. So the key to having a successful management company is having good systems and processes and reporting. That, I
Hmm.
mean, you just need that. You need to have somebody who wants to spend time on operations.
Yeah.
Now, I don't spend much time on operations anymore. I did, right? I developed all the systems, processes, and our people have, made them better. But you have to be prepared on the beginning to spend some period of time doing that, because
Yeah.
it's not going to happen by itself. It just won't. And in the beginning, it'll be a lot of work that you have to really appreciate the benefit that it's going to bring you, and that is you're going to have tighter control over your assets.
Yeah.
So
Yeah.
I don't necessarily recommend it to everyone, because not everyone wants to do that. Not everyone wants to dive into operations, and
Yeah.
some people love it. Some people love it. It's not my love. We know how to do it. We know. I mean, after 26 years and 16,000 units, what you do is you find everything that has gone wrong. You have fixed. You have figured out why it went wrong. You've documented the solution and systematized the process so it doesn't keep happening. Right.
Yeah. Right.
So you have to do that. And if you don't commit to that, your management company will not be successful,
Right.
because that's the key there. Because there are people moving in constantly. You have to have good quality. You got to have good move-ins. The units need to be ready. You have to have feedback loops all the way up to the top, so that the top dog knows that it's not going well on the bottom floor, right?
Yeah.
All that stuff. It's a business. And
Yeah.
so if you're not ready to commit to it, I would not. If you have a good third-party manager in Columbus, I wouldn't upset that apple cart yet until you have to. That's
Yeah.
just me, right?
Yeah. 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 Well, yeah. And good's relative, right? I mean, it's not it's not a binary judgment. It's like, okay, they're good at this, but could be better at this, and we could know more about this, and that sort of thing. It's always a matter, I think, of, I mean, sometimes it's a swing and a miss, quite frankly, on
Yeah.
the
Yeah.
PM. But you more often it's like, okay, right now they're at a, we're giving them a B or a B minus,
Yeah.
and how can we get to an A or A minus performance? And it's complicated. There's the who, not how conversation, right? Because it's all about those people that you
Yeah.
have in place. But
Yeah.
then, like you said, it's all about your reporting, your systems and processes, your your management platform. I'm assuming you're using like a Yardi or
We use
one.
Resman. Yeah, we use Resman.
Okay.
Yeah, it's
Okay.
easy. I will tell you, we used to do third party management. So
Okay.
we have for a long time.
And for listeners, what Ken means is that he managed other people's properties
That's right.
within his management company. Yeah. Yeah.
That's right. So we stopped doing that. We still have some third party clients, clients that we resonate with. We get there's good synergies with them, but we're not taking on any more third party clients, because here's the reason third party management is tough. I analogize this back to my CPA days. When you deliver a tax return as a CPA, no client ever says, "Wow, man, that is the best tax return I have
Yeah.
ever seen." Never happens.
Right.
Third
Right.
party management is the exact same way.
Yeah. Yeah.
The best you can hope for is a B.
Hmm.
Maybe
Yeah.
you'll get an A, but there's nothing. So what happens over time is there's a lot of things that happens in the third party management world. Third party managers are oftentimes asked to fix the problems that the owners created by not doing due diligence, not knowing what they're doing, just unreasonable business expectations. And then they have to try to fix that. That's one thing that goes wrong. The
Yeah.
other thing that goes wrong is just you're trying to get people to be motivated, and nobody in this third party chain has the motive, the incentive, the carry that the owner gets, right? See, in
Yeah.
our world, there's really good incentive for us to make sure we line all this up, because
Right.
we're benefiting, right? Third party managers, where's that big incentive? You see, because it's
Yeah.
hard for you to build that incentive into your P&L. But if you can
Yeah.
find a way to do it, I always believe if you can line everything up in your company so that everybody is marching to the same goal, and you do that through incentives and all that stuff, then you're golden. And that's what we've been able to do. But it is very hard to do that with third party, because most owners don't want to go and provide incentives for people that are not their employees. They're
Yeah.
third-party managers' employees managing their property. You see how it gets weird? It gets
Yeah.
wonky.
Yeah.
So
Yeah.
it's hard to incent those people. So it's a tough one. That's why I said, if you found a decent one, stick with them, man. Take care of them. I'm lobbying on their behalf, but it is tough work. It
Yeah.
is tough work because you can do 99,000 things right. And that one thing you did wrong, that's the thing that you will talk to them about.
Right. Right. Yeah, that's a really interesting point that I had never honestly considered before is putting an incentivized structure in place with the management group. And I wonder, you talked about the difficulty of incentivizing individuals in that group. I wonder about just incentivizing the whole group, right? Like just incentivizing the whole contract
You
somehow with
can,
the
but
team.
now, now we're going to get into the weeds on third-party management. What happens is most third-party management companies, they employ people, but so there's two levels to them. The level of regional manager and above is the property management company's responsibility and their profit center. The property employees and below, those are separate. So they do two things. One, management companies try to manage their profitability by pushing down as much as they can within their contract, right? I'm sure they're not ripping anybody off, but they are doing that. So if you incent the contract, there's no guarantee that incentive is going to find its way to the maintenance guy, to the leasing agent. And so those are the people that you have to also incent. So I've found in Florida, the third-party management world, because remember, people trade properties in Florida like they change their shirts, right? I mean, it's just nonstop. So who gets abused in that process are the poor on-site people. They show up to work one day and a new owner shows up and they don't even know the place was sold. They get axed, no incent, no severance, no nothing. Get out of here. It's not our, they sold the property. Sorry to hear that. So there's so much abuse that's gone on. It's actually thinned out the ranks in the property management world. It's really a tough business. It really is. So when you have those kind of, I'm lobbying for your property manager, but just remember they're in a tough spot.
Yeah. It's a tough business. And so many, I mean, it seems like eventually all of the very, very few of the big hitters in our world are using third party. Eventually everybody gets vertical on management. And I think for obvious reasons. So
because you can hire somebody and pay them enough to run your third party, or you run your property management business. Just like you're paid a third party manager.
Yeah. And do you think that requires being location specific with your portfolio? In other words, do you have the regional and then on-site structure?
Yeah. I mean, if you've got properties spread all over the place, one here, one there, that's hard. I mean, that's hard, right? Because now you got traveling and So the more spread out you are like that. I mean, if you have clusters of properties in one area, like you have 5 in Columbus, I don't know how many units that is, but it's easier the more bulk you get. I don't know how many units you're at, but
600-ish, but
no, that's, I mean, I would, if I were you, still stick with third party if you can make it work.
Okay. Interesting. Let's switch gears. So, the fund model is one that is continuing to grow. I think in popularity is one way of looking at it, but there's just a lot more on the equity side. Sponsors, syndicators like us that are moving from raising capital for individual opportunities to raising capital for funds, right? That for an overall fund. You're into fund number 4, is that correct?
We are.
Yeah. So, and I guess when was your first fund? When did you launch your first fund there? It wasn't that long ago, right? It was
maybe 2020, maybe.
Yeah.
I that might be wrong, but I think it's right.
Okay.
And we've done a number of syndications prior to that.
Yeah. Okay. Yeah. So talk about, maybe how that is different, that post 2020, you're into your first fund versus say 2017, 2018, when you were I'm assuming you were raising for individual opportunities, individual properties at that point.
Yeah. So I'll talk about the switch to the fund model. Remember we're predominantly in Florida.
Yeah.
It is extremely competitive. and most people in Florida are syndicators. So somehow you have to figure out how you're going to get that deal. Somehow you have to set yourself apart. Everybody says they can raise the equity.
Yeah.
But can they? Will they? Do they? Right? So
Yeah.
somehow you got to differentiate yourself, and you usually got to do that with price. And that's what we were finding, right? And so it just got frustrating. So I said, wait a minute, because I'd been at Deloitte, I'd done a ton of private equity work and all that. So I'm very familiar with the concept. And I said, you know what? I got to find a way to differentiate ourselves. I mean, we're just not making as much money as we could. We did really, really well. I know we could do more. So I thought, let's do this. The first fund is a challenging fund to raise. Because what you have to have is now, if it's called a blind pool fund is what it's called. Right. So for your listeners, that means an investor signs a subscription agreement, gives you their money, and they said, okay, Ken, I trust you.
Yeah.
Go buy a deal. I mean, that takes an enormous amount of trust. The reality of it is it doesn't take much more trust to do that than you do writing your check to the syndicator, because you still have to trust the syndicator to do a good job. And you know, you're not usually underwriting the syndicator literally like he is. So there's just in reality, it just requires a little bit more trust. But in the investor's mind, you have to have an investor and you have to have a track record to show them that you've been there, done this for a long time. And they have to really have high confidence that you can deliver. That's the key. Yeah. And so it was a little hard at first. It's changed considerably because in our fund one, right, the first deal never saw the market. So now I'm trying to prove my hypothesis. Second and third deal, we were not the highest bidders. Why did we get them? We got them because we'd already raised the fund.
Yeah, that's huge. That is an excellent point. That again, I hadn't ever fully considered is the competitive advantage that it gives you when you're in a highest and best offer trying to win a deal. To have the equity in place, it's huge.
We got our last deal because we'd already raised the money. Yeah, there was no equity raise for us. There was plenty. We raised more than enough money to close that deal.
Yeah,
that is the reason we got it.
And for listeners to contrast that, we literally at Greenlight here, and it's May 1st, 2024, as we're recording this, literally 3 hours ago, just submitted basically a highest and best on a highest and best on a CFO. Like, so in other words, this was like maybe our fourth submission.
Oh my!
On this particular property, we've been trying to win to win through this broker and from this seller in Columbus, and did a buyer interview or seller buyer call interview where we're on with the broker, we're on with the seller, and us, of course, and the primary conversation. Of course, they want to know how we underwrote debt, how we underwrote taxes, insurance, and all that, and but the primary conversation is where's your equity? Where's your equity coming from? How are you gonna get the equity? And the way that we are currently set up is we raise from our LP pool, our investor club, if you will, which you can join at investwithgreenlight.com, by the way. And so we have 700, let's say, limited partner potential investors in that CRM, and then we have people like Ken who may have funds that are investing in other people's deals, which I don't. You're probably not doing, right?
Yeah, no. If you give us your blank check, I commit to you that I will never go into a deal that I don't control.
There you go. Yeah. So there's that option. There's the co-GP option where we bring in other people into the general partnership that are raising from their own LP pool. And then there's, of course, more of like the institutional check writers, bigger check writers as well. And that, that's what we have to work with at Greenlight. But that fund model gives you just a tremendous advantage. I'm just kind of realizing even in the course of this conversation of having that equity in place. And when you can tell a seller and a broker that's really, really powerful, I think. And like you said, you're going to win deals that you aren't necessarily the highest price on. So you're in not only you getting the deal, but you might be getting the deal at a better price than you otherwise would.
You nailed it. You nailed it. But again, making that transition is tough. Yeah. It's tough. Yeah. I mean, a lot of people want to do that quasi underwriting next to you.
Yeah.
Right?
Yeah.
And you just can't have them do that in the fund model. You can't.
Yeah.
So you just spend more time making sure they understand what you do, why you do it, how you do it, all that kind of stuff. Yeah, no, that's really
So it becomes a very much a marketing effort, right? Because you're having to paint a picture of how things are going to go once they write a check, send you their money, without the specifics of a business plan that's specific to a deal or a property. It's more a general conversation about how we, our buy box, how we vet properties, how we run our business plans, et cetera. So, how do you tackle that? Right. The marketing piece, is it webinars? Is it, is it social media? Is it, just hand-to-hand combat with one-on-one conversations? All of the above.
Yeah.
I knew that was
you
coming.
Have to all of the above. And what is important is you have to be prepared to give people time to get to know who you really are.
Yeah.
And we have our entire our entire track record has been verified by Verivest. It's out there. You can see it on their website. You see it. You got to stack all these things so that people really understand what you're doing. And, you need that trust level. I always tell people, if you need, this much, give them this much in order to get it done. And that's what you have to be prepared to do. And because they should do their due diligence, right? They're giving you their money and they're entrusted. Right. They trust you to make good decisions. And just whatever you do, make sure you structure everything so that they're first. Don't mistreat an investor ever, because I watch people do it and it goes through the little network like there, you wouldn't believe, right? The internet is bad news spreads very fast on the internet.
Sure. What would be an example of a way that you've seen investors mistreated in this case, in your words?
Yeah, they get the deal done. And then I hear this a lot. This is really frustrating. And it's part of I get me on my soapbox because it affects you and I. When people will get their deal funded and then the investor calls, they never get a call back. They don't get any history. They don't get any communication. This stuff really happens. I mean, it's unspeakable to think that would happen, but it does. I mean, that's an extreme example. Other examples are, really high fee structures. Sometimes there's so many people in a GP pool, they're trying to feed too many mouths, and asset management fees are very high. They just, it's just too fee heavy. That's the most common abuse that I've found.
What are your investor communications look like? Once people are in your fund?
Yeah. So we do regularly something I call the Real Deal webinar. We just had one, I think it was last week or something like that. We do them roughly once a month. And I tell people what's really going on. What is our occupancy at each one of our properties? What's my take on delinquencies? What's going on? How many leads are we getting? Literally everything that's going on the ground, as well as what's happening in the market that is impacting. We've been talking about interest rates, obviously, for a long time. So we do that, and it's interactive webinar, just like you and I are talking. I don't lock down the chat. It's not a webinar, Zoom. It is a back and forth meeting because I want to be able to answer their questions. And then anytime they call, everybody has my cell phone. You have a question, just call. We're going to give you the right answer, real answer. And then we do regularly quarterly financials. They get, P&L, balance sheet, rent roll, and then they get a real narrative that we write. This is what's going on at the property. This is what we're doing with this renovation or that renovation or whatever happens to be going on. And we have a portal. We have a really nice investor portal that all that information's in there, so they can always see what's going on.
Yeah. Do you mind me asking what portal you use?
Yeah, we use Appfolio. Appfolio. It's really a nice program.
Yeah. Yeah. And there's a few out there. We've used Syndication Pro. We're actually switching to Agora right now. And probably should disclaim Ken. I don't make assumptions about you. We have no official affiliation with the platforms, but I mentioning them just to be more helpful than anything else. So, Yeah.
I will tell you, Appfolio has been really good on customer service. Anytime we are not sure how to do something, we just get on the phone. They help us right through it. They're good. Yeah. Again, I have no affiliation with them either, but it's hard. I don't want to see people make mistakes because you spend a lot of bad time trying to fix problems when you make a software mistake. You know what I mean?
Yeah. Yeah. 100%. Okay. So again, switching gears a bit, although I think this is pretty related, you're very strong on just kind of in general investor education. I think you
Extremely.
mentioned that to me,
Yep.
just before we went on the air here. Talk about, what you do there. And I'm assuming
Yeah.
that this is investor education, both inside your current investor base and then just in general, as well,
Yeah.
outside as, to prospective, passive investors. What do you do there, Ken?
Yeah. So we do, our company is set up so we want to help you create wealth in real estate. If you don't have time to do it yourself, then you go on the passive side and you invest with us. And our returns have been really, really good.
Yeah.
If you are the person that wants to figure out how to do it yourself, then we can teach you that as well. It starts off with our underwriting program. Having a CPA, commercial lending background, right? You might think that I care about underwriting. So we teach people exactly what we do. We give them the exact same spreadsheets we use. Everything that we do, we teach it to them. And
Okay.
then we sit with them every week, once a week, the Q&A, because you and I know that once you get real financials, it's going to look different than any course anybody puts together. So we make sure that they get through that process. And then the other program that we have, we call it the AMA program, Advanced Multifamily Acquisitions Program. It takes people literally from knowing nothing about real estate all the way to the close. And I mean detailed. We do a personal SWOT analysis to figure out what you're good at, what you're not good at, what do you need. We help them with their personal financial statement. I mean, every little step all the way to close, including due diligence and raising capital. And right, we've done it 19 times, right? We've done 19 deals, so we know what it is. The reason we got into the investor education side is a little selfish and not so selfish. One, it is really hard to compete with people that have no idea what they're doing, and they way overpay, and that it's not going to end well, and you just know it won't. So
Right.
it's painful to watch people do that. Plus, you lose the deal, but it
Right.
also affects us because they have investors in their deal that now have lost money.
Yeah.
And
Yeah.
that just makes our job that much harder, right? I don't want this whole private equity real estate business is incredible way for people to create wealth. And if people that don't know what they're doing, if they're not careful, they can screw this up. And the SEC will go in and change the rules. And that would be a disservice to everybody, right?
Yeah.
So that's the first reason we started doing it. The other reason we started doing it is just because I got older. I just realized, if real estate's had such a huge impact on my life, people helped me in the beginning, not quite as much as we are helping now, but I just know because there's a lot of people who want the very same changes in their life that I wanted 25 years ago. So those are the two reasons that we do it.
So, okay. So I guess I maybe misunderstood a bit. So the investor education piece for you it's largely geared at training like lead sponsor or syndicator type folks.
Yeah.
Like
But we
yourself
have a lot
and
of,
myself.
we have a lot of passive investors who say, you know what? I don't want to have a clue. I want to know. They love the underwriting course for that.
Yeah.
Because they're looking at syndicators. They know that syndicator doesn't have a lot of experience, maybe.
Yeah.
So they want to kind of feel that out, right? Is this making sense? And so we teach them that. And we have a lot of,
I mean, it's, being a coach myself and having a mastermind myself where I'm coaching and training, mentoring, other lead sponsors, right? Or lead sponsors that are in the works, so to speak, future lead sponsors. There is so much to it, man. It's and I mean, you talk about the beginning portions, right? The broker relations, the deal flow creation, the deal analysis aspect, the starting and growing your investor base and getting that messaging out. And then, man, that contract to close process is such a beast. Like, I've thought about either writing a book or doing something that just like called from contract to close, because the amount of moving parts from due diligence to capital raising to legal to inspections to just the due diligence piece alone. But then title and just entity formation. It just goes on and on and on. It's so big, and so.
And it all has to happen in a very short period of time.
Yeah. You're at 100%. That's the added element is you're in a quick fuse timeline, as you said.
Yes.
How do you structure that? Like, what are your deliverables on in your education program?
Yeah. So, for example, let's say we're talking about the first phase of our program where we're trying to understand you You're trying to understand you. What are you trying to do? What's realistic for you? At the end of our first phase, we need to have a business. You need to have a business plan that works for you. That's not, it doesn't work for me. It's got to work for you. So that's why we got to understand your personal strengths and weaknesses. We go through that process out loud. Your personal financial statement is going to be done because you and I know that takes a minute, especially if you've never done one. And now it's done. And what happens when the lender wants to see it? There you go. You don't have to do it from scratch. So we set all of this up. We want them to understand what market should they, just even figuring out where they should look is a challenge, right? Because all right, so there should be some rational logic to that part of the business plan. And so we're just going to take them step by step through that process. Now, as you go into, let's say, due diligence, well, after doing 19 deals, it stands to reason that we might know how to do due diligence. So our deliverable is our entire due diligence system that we literally use, including teaching the people who are doing the unit walks exactly how to do the unit walk, exactly how to get around the apartment so you don't miss anything, exactly how to do it when there's a tenant there, exactly which pictures you should take. Like, it is literally turnkey. So every phase of this process, that's what we give them, because if you've never done due diligence, you don't even realize that standing in someone's apartment with your iPhone, click, click, click. They're like, dude, you're taking pictures of my stuff, right? What do we tell them to do? Turn off your phone sound. It's not, they know you're taking pictures, but you don't need to remind them with click, 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 click. Just every little detail like that is what we deliver. That's what the US are deliverable. That's what it is. And we go through that whole process that way.
Is this a group education format? Is it one-on-one? Or?
It's not one-on-one because I'd run out of time for that.
Sure.
But it is, so the online course, it's me teaching the course through videos. And then we do once a week, we do a 1 to 2 hour group coaching call. And that's where we do that. And the people, I will tell you, the people in our group, they're intense. They're ready to go. I couldn't be more proud of the groups that we've been able to recruit for these programs, because they're focused and they're ready to go. And that's why I'm doing this, right? Anybody can do a course and take their money, but this is really important because these people are actually moving through the process really well.
Yeah. That's key for me too. I've gotten to a point where the difference between curious and committed is so massive when it comes to who you bring into a program like that. And and these days, especially, I don't know that it's ever been harder to do what we do. To be very simplistic about it, but especially on the capital side. And I don't know that it'll ever get any harder. In other words, I think if you can do it now, then you're in really good shape moving forward. But it takes everything. It takes an all in, whatever it takes kind of effort to get deals done these days. And I'm sure you'd agree with that.
Completely. Yes, absolutely. Yeah. But you know what? I will tell you that the future of investing is this market that we're in, this private, I call it private equity. That's what it is.
Yeah.
Right. It's now, it used to be just the really, really rich people. The institutions had access to this stuff. Yeah. Now it has come down the chain a lot where it should be. And I'm telling you, it is the way to invest. I mean, I suck at the stock market. I don't even put stuff in the stock market anymore. I just don't. Right. Because there's no reason not to. So anyway, it is, if you're thinking about it, if you're on the fence, this is something you need to do, because the amount of money you can make and the amount of lives you can change is really unbelievable. That's why I'm here doing this.
Yeah. And this is probably a really good place to kind of round out, because we're unfortunately almost out of time. But is that, when you say that, is that message towards the passive opportunity or the active opportunity, or both?
Both.
Yeah.
Okay. Both. I've done some math, of course, because that's what CPAs do. But I did some math a long time ago, and I figured out that if I bought a deal, put in $100,000 in a deal, and all I had to earn was 18.5%. Now I thought that sounds high, but if you look at our track record, it's not unrealistic at all. Yeah. Can't promise that, right? There's no guarantees, but that's the assumption I made. If I do that and I buy an asset, I get the cash flow at 6%. I sell it right at a 1.8. I mean, that's not ridiculous, right? To
equity multiple.
An equity multiple. That's not ridiculous at all. Pay the tax, do that over a 5-year period, do it again, again and again. So you do that 4 times, that 100 turns into $1 million.
Yeah.
Just as a passive investor. Now
you
what,
add 7 years, 8 years kind of time frame?
No. So that I made the assumption that it's 5 years per.
Okay,
right?
got it.
It doesn't have to be, but I made that assumption, right? Because it just depends on where you're at in the cycle. So that turns out to be a 20-year period, but but that's also paying the tax.
Yeah.
Every time you have gain. And so that's important. So 100 turns into $1 million. Now imagine if you're doing this with your IRA, which people can do, that. You do that 3 or 4 times. I mean, that's as a passive investor. Yeah. Right now, again, be the sponsor. I mean, that's ridiculous. You can 10x that, right?
Yeah, for sure. Yeah. I can't believe our time has flown by here. This has been fascinating, Ken, as it was last time. I guess a couple things. What's the best way for listeners to learn more about you, learn more about how you do things, your program, your funds, all that stuff?
Yeah. So KRIPartners.com. KRI, everybody gets that backwards. KRIPartners.com. Just go there. And you can email me if you want to, KGEE@KRIPartners.com. But if you go to our website, there's a contact me form on every page. It comes right to me. And then I'll make sure you get really well taken care of. And that way you can investigate our training side as well as our investing side.
Awesome. One last one. This may not be fair because it hopefully doesn't require too deep a dive on your part, but grand scheme of things, where do you see us now? Where do you see us headed? In other words, do you agree with me that it's about as hard as it's going to get right now? And where do you kind of see things headed here?
When you say hard, you mean hard to buy?
Yeah, hard to buy and hard to fund. Yeah.
You're probably correct. But here's what I will tell you. Warren Buffett tells you, don't run out of the fire, run into the fire.
Right.
You need to run into this fire right now because the people that did it in 2011 made obscene amounts of money, right? We don't know that that's going to happen, but I will tell you, we are all in right now. We have set up our latest fund so that it just pulls down all the barriers that made it hard for us to find our last deal. And you've got to buy. I personally feel you got to buy as much as you can right now, even though it's hard. You got to suck it up, because if you can get a newer asset at close to a 6 cap in a market like Florida, my friend, you need to do that.
Game on. Yeah. Awesome. Ken, thanks so much, man. This has been awesome stuff, and really appreciate the value you brought to me and to the listeners today. And looking forward to doing it again here in a year or so, and catching back up and getting our heads back together and seeing how things are going at that point. So really appreciate you.
I appreciate you having me back. Really, I do. Thank you so much.
All right, bet. Listeners, thank you guys. Love you guys. We'll see you on the next one. Take care.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.